If you have a bank account, then your bank deposits today are probably pretty straightforward. You deposit money into a bank account where it exists digitally as an entry into the bank's centralized ledger. This digital balance can be accessed and managed through online banking platforms or mobile apps in which you can perform actions like making a payment, transferring money, or withdrawing cash. You make a payment with a simple click of a button. However, the underlying process involves multiple intermediaries, especially for cross-border or interbank transactions.
For instance, sending money to someone at another bank may require clearing and settlements through central systems, often leading to delays of a few hours to several days. If the transfer is international, the process may involve currency conversions and additional fees, further increasing costs and wait times. Additionally, banking services are typically tied to operating hours, meaning transactions initiated outside of these hours, such as on weekends or holidays, may not be processed until the next business day.
While modern tools like credit cards and payment apps mask some of these delays, the underlying settlement still follows traditional schedules in many systems and countries around the world. The alternative to this centralized model is tokenized deposits, which use distributed ledger technology to create digital representations of bank money. Tokenized deposits promise efficiency and speed, but raise many questions about the safety and privacy of money. Could every payment you make be visible to more parties than you'd like? We'll try to answer that question in this video.
Tokenized deposits also differ from other forms of digital money. Unlike cryptocurrencies, which are often decentralized and unregulated, tokenized deposits are fully integrated into the banking system. They are issued by banks under strict regulatory oversight, ensuring they are as stable as the dollars or euros in your savings account. Yet their potential goes beyond being a digital version of cash.
These deposits are programmable, which means that, for example, you could execute transactions like supplier payments by triggering smart contract rules. Some compare tokenized deposits to stablecoins or CBDCs. These are not the same. Tokenized deposits work differently from stablecoins. When a payee transfers money to a recipient, the sending bank burns the tokens and the recipient bank mints them so they appear in the recipient's wallet. Unlike CBDCs, which may centralize financial data under the control of central banks, tokenized deposits maintain the decentralization and transparency that blockchain offers while still adhering to banking regulations.
As I have already mentioned, blockchain's transparency could expose sensitive data, but privacy-preserving technologies like zero-knowledge proofs and confidential transactions are emerging to address these concerns as well. For instance, these tools allow transactions to be validated without revealing sensitive details, thus ensuring privacy without sacrificing security. I'm talking about these innovations in present form, because we have already seen some adoption on the tokenized deposits. I want to share with you two concrete examples of how it's being implemented across the globe. First, let's talk about the JP Morgan's Kinexys, originally built around the JPM coin system.
Kinexys facilitates tokenized deposits for secure and real-time intra-bank and cross-border payments. Since its inception, the platform has processed over $1.5 trillion in transactions, with an average daily volume exceeding $2 billion. Leveraging a permissioned blockchain infrastructure, Kinexys enables near-instant settlement, 24/7 transaction availability, and programmable financial operations using smart contracts. It is also expanding into foreign exchange settlements, with the dollar and euro initially supported, providing on-chain multi-currency clearing. Clients such as Siemens and BlackRock are already using Kinexys for liquidity management, automated funding, and reduced transaction costs. Let me give you another example.
Swiss UBS, PostFinance, and Signum have agreed to a trial for deposit tokens. The Memorandum of Understanding outlines a pilot project running through late 2025. The trial focuses on interbank peer-to-peer payments, so using tokenized deposits to facilitate direct programmable transactions between banks. The deposit tokens in this trial will be built on a private blockchain infrastructure. It will support automatic settlements where the exchange of funds and assets occurs in a single transaction, eliminating risks associated with traditional asynchronous processes. The trial also seeks to ensure interoperability among participants, creating a scalable system for later adoption by additional banks.
To summarize, these initiatives show that the financial industry sees a real potential in tokenized deposits. Unlike crypto, they are regulated, stable, and fully backed by bank reserves, while avoiding the centralized control of data seen in CBDCs. Privacy-preserving technologies like zero-knowledge proofs ensure security and confidentiality.
However, their success depends on addressing critical questions about privacy, reliability, and inclusivity. As promising as they are, tokenized deposits are not a perfect solution, and they shouldn't be blindly trusted.
Instead, they should be seen as a work in progress, a bridge between the systems we know and the systems we hope to build. Whether they live up to their promise depends on how they navigate the challenges they present today.
Thank you for exploring this topic with us. If you are fascinated by how technology is shaping the future of finance, stay tuned for more insights on DLT. Until next time, this is Dominik.
And this is Przemysław, reminding you to stay on the block to stay ahead.